and welcome to Money Matters. My name is Jim Butler with Marcum Wealth, and my co-host today is Mike Deaver of Brandywine Asset Management. Good afternoon, Michael.
Hey, Jim. Good to see you.
Good to see you. We're going to have an interesting conversation today with a good friend and colleague of mine. Before we have that conversation, Mike, why don't you and I touch on a couple of highlights that just passed us by? Certainly, as we don't like to date ourselves with the taping of the show and when it actually gets aired, but 2023 ended up being somewhat of a surprise year in many respects. And going back to January 1, 2023, most people would not have even come close to predicting the outcomes that we saw in the economy and the markets. So let me just ask you, in a general sense, what stood out to you as to maybe one of your major surprises, whether it's in any clients that you're working with or in the portfolios that you're managing?
The market is always a surprise. I think when you look back, go back 2 years, at the end of 2021, the general consensus was that everything was going up. We were in almost a mania. I would have to call it a mania, speculative mania with NFTs and cryptocurrencies and real estate and stocks. Everything just was going phenomenally well. And people went into 2022 expecting more of the same. That turned out to be one of the worst years on record. And we came out of that into 2023 with people expecting more of the same, raising rates, lethargic markets at best, potentially a continuation of the big sell-offs in the bond route we had and the stock route we had in 2022. And instead, 2023 turned into one of the better markets in history. So I think it's just an example of markets, stock and bond, just doing what they always do, which is try to confuse as many people as possible and do the opposite of what the majority of people expect to have happen.
Isn't that the truth? And, so one of the things that we were talking about earlier is an article that I had read, and I'll give credit where credit is due. Ben Carlson, who writes an article referred to as a Wealth of Common Sense, does a lot of data gathering. And just a couple of points that he brought up, which I was absolutely fascinated by, is, as you said, 2022 was one of the worst years ever in the financial markets, and the third worst year for a 60-40 portfolio, 60% growth, 40% bonds. Seventh worst year for the S&P 500. Now, again, this is 2022. The worst year for the Barclays Aggregate Bond Index, which is a broad bond indice, and the worst year ever for the 10-year Treasury. And so you turn that around, and in 23, we had the NASDAQ that was up. NASDAQ 100 was up 55%. The NASDAQ Composite was up, I believe, about 44%. The S&P 500 was up about 24, and the Dow was up roughly 14. And so, it just, miracles never cease. And so one of the questions that we get this time of year is, well, then what does 2024 look like? And, who knows what 2024 is going to look like, particularly with what we've just touched on.
Right. It's in the short term, it's really driven by sentiment, and the sentiment's really contrary sentiment. As we pointed out before, the sentiment got to an extreme in 21. We just published the year before that our write-up just based on math, what we expected 60-40 portfolio to do in the 2020s, and it was really an underperforming, underwhelming kind of analysis. And all we did was run numbers based on dividend payouts, earnings growth, current interest rates. It's just basic math. Not to that. That's looking much more favorable today because of the bond environment. The 40 portion of it. So my expectation. I don't really have a short term, like a 1 year view on things. I think overall, we're in a better spot than we were 2 years ago.
Mhm.
We're not in a. It's not like a throw all the money in the market kind of. At best we can see, like maybe at the trough in 2009. It's nothing like that, but I think we're probably in a more normal environment now because interest rates have normalized, to a large
Right.
extent.
Right. Well, and our guest who has a niche in the real estate market, and we'll get to him soon enough. But that's going to add another color to our conversation because the world in which we live tends to be more in the stock and bond arena. Some alternative investments and a variety of approaches to managing those portfolios, but there's something else that I find interesting, and it comes to us through TV advertisement, which is not a good source of information generally. And oftentimes it comes to us from client inquiries and just curious as to, what if the market tanks again and, one of these doomsday scenarios plays out as, we hear not from time to time, but Mike, I would say on a regular basis. It truly does amaze me how frequently somebody is always predicting what the market's going to do in 2024 in this case, or the near term, and that the bottom is going to fall out and the worst is going to happen in our lifetime. And then secondly, people who, human nature being what it is, just listen with ears wide open and say, uh-oh. It's just mind-boggling that those characteristics happen, and you touched on it before. We don't know. Nobody knows. Could it happen? Yeah. What's the likelihood of it happening? I don't know. Something less than 10% would be my best guess.
That's probably realistic. I mean, the people you're seeing on the news and the people on TV shows and talking about what the market prognosticators and people like that are, they get rewarded for being extreme. So the reason they're on the shows is because they have some sort of a exciting story to tell, and people want to hear that. And you'll have some of the same people year after year after year predicting doom and gloom, and every so often they're going to be right because it happens. But it doesn't mean that you should stay away from a long-term plan and accumulation of assets, savings plan. I mean, it's all essential regardless of whatever people think is going on.
Well, one more piece of information before we turn it over to our question, and this comes to us from JP Morgan, and that is over the past roughly 70 plus years, the S&P 500 has averaged just over 11% per year. So there's rocky times in the middle, but on average over time, as you point out, things have a way of working out. Let's shift, if we could, to the question. Emma Kellerman from Philadelphia is asking very simply, what is a miner in cryptocurrency?
So cryptocurrency, when this cryptocurrencies really came to the forefront with the launch of Bitcoin almost 14 years ago now, 15 years ago, and it was structured to allow a set number of Bitcoin to be mined or be in circulation in total in all its history, and that was 21 million. And the way they came into existence is people solving mathematical formulas and getting rewarded for that. And those formulas are helping to manage transactions, keep track of who's buying and selling, trading off Bitcoin to each other. That's the purpose of those transactions. But they get rewarded in Bitcoin. And so people are running these complex computer algorithms to come up with solutions that when they hit it, they get a certain number of Bitcoin. Every few years, about every 4 years, the number of Bitcoin they get for doing that is cut in half. We're really close here, another couple months away from instead of getting 6 1/4 Bitcoin every time somebody solves that, the 3 1/8. And because of that, it's getting more and more difficult to mine Bitcoin, but the price keeps going up to compensate for the fact that it's more difficult to mine. And so it's a algorithmic process, computerized. It's not actually digging in dirt, but they use the same terminology as if you were mining for gold.
So that doesn't necessarily mean there's any appreciation in the underlying value. It's just that the value has to adjust because the number of shares change.
Yeah. Well, essentially what it's saying is that you're getting less reward in Bitcoin for doing the same amount of work. And because of that, if the price isn't going up, people aren't going to be rewarded to mine, and that's not going to continue. So essentially price has been going up and compensating people for the mining operation being
Right.
more difficult.
Right. Well, thank you, Mike, and
Sure.
thank you, Emma, to writing in. Hopefully that brings you a little bit closer to a good answer. And if you have questions that you would like our panel to address, here's how you send that to us.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Welcome back. And our guest today is Trae Lamborne of Egress Solutions. Welcome, Trae.
Thanks, Jim. Hey, Mike, how are you doing?
Hi, Trae. Very good. Thank you.
Well, we're going to have an interesting conversation, I believe, because now you're going to open up the door to a completely different arena. So to kind of set the table, Trae, can you give just a brief background as to what you do, what your firm does, and how you basically have come into being up to this point?
Sure. Yeah, I've been in the construction industry for about 30 years, 27 of those years as a business owner. Egress Solutions, we are more on the supply end, sales and distribution of product in the construction industry, and quite involved with both commercial, residential, construction. So deal mainly on the new construction side of things, but highly involved in real estate all the way around.
So is there a breakdown between residential and commercial work that you do?
Yeah, for our products, I'd say majority of our products are about 90% residential and 10% commercial, more like mid-rise, low-rise types of buildings where you have offices and or, retail in the bottom level, as well as, maybe some apartments and things like that, second and third floor.
Go ahead. Yeah. So what are you seeing in the housing market now? Do you see, is it a shortage? Is it a surplus? I've been hearing about a shortage. Is that the case?
Mike, it's such a loaded question, and the economy, probably just like the financial market, it's interesting to say the least. So yeah, a shortage, yes, quite a shortage across the country. I'd say typically, we need about 1 million units in the U.S. to keep pace with population. And that's just new construction units. We probably fall on average, I'll tell you, as much as 20% short each and every year. We haven't hit the million home mark since about 2004, 2005.
Does that mean less? The houses that are used and have been maybe being deserted or abandoned or something aren't now? I mean, obviously you still have the people. Are they doubling up in homes, or where are the people going if they can't go into a new home?
Sure. Yeah. I mean, you see the rental market exploding. You see a lot with the multi-generation living, whether it be, with their parents, grandparents, or sometimes even the other way. You have, parents selling their big home moving in with their kids. And like I said before, the rentals are at an all-time high. Overall, much like with the financial market and joblessness, when that goes up, the foreclosures, the bankruptcies, people walk away from their homes, we're starting to see an increase in that already too, from what I hear and understand from some of my friends who are realtors across the country.
Wow.
Yep.
But Trae, now translate that into the work that your firm specializes in, because certainly you're impacted by that shortage of supply, and it's a problem that's been around for quite a while. Does that actually help a firm like yours, where you're looking to improve an already existing structure? Is that fair?
Yeah, I mean, with our products, we're mainly geared towards the basement level. So when you have multi-generation living, maybe even a basement apartment, things of that nature, our products come in quite handy, and we sell more of them. So from a sales aspect, our sales were up slightly this year, looking to increase that even more in 2024. So I guess that's a good thing for us across the country. Even talking to some of our manufacturers, you'll see out in the West, that market has already softened. So it's real streaky right now, I'd say, across the country. In the East, we just seem to be lucky where people are still buying, still building, even with interest rates creeping up. I know some of the younger generation has complained a little bit about interest rates. I think the three of us, as more mature gentlemen, have seen interest rates quite higher than this. Probably even our first homes were bought at a much higher rate than this. So the fact that we're in a shortage of homes, there's not enough, existing homes on the market, and with interest rates being somewhat manageable right now, there's still a high demand, at least in the New York, Philadelphia, probably DC market. Obviously the most highly populated area in the U.S. as it is. So our business is strong, to answer your question, Jim, more directly. And hopefully it's only getting stronger with the amount of new construction still being built where our products go. And then, like I said before, multi-generation, people using that basement level, just increases our demand for our products.
So you had mentioned geographically that you tend to focus in what's typically referred to as the Mid-Atlantic region, right? PA, New Jersey, Delaware, maybe Maryland. And as we know, that's a very densely populated area. Would you say it's one of the stronger, if not the strongest region in the country at this point?
Yeah, at this point, I would say definitely the strongest. I mean, again, we've got representation all across the country from our manufacturers. So we're all involved in that new construction level. We all kind of keep our finger on the pulse, and this area definitely seems to be the strongest. Because even you look at people coming from the New York area down to the Philadelphia area, it's quote unquote affordable for them to move down here. Then you add in multi-generations in a home that was $1 million in North Jersey. They come down to the Philadelphia suburbs, and maybe 600,000 or 700,000, and they put two families under one roof, and now it's really, really affordable.
So Trae, what if we're falling short in new housing construction every year? What are the challenges there? What's holding it back? If the demand is there, why aren't they being built?
Most of your builders, national home builders, developers, it's the red tape. I'll be honest with you, Mike. It's a lot of the red tape, with taking about 2 years, I think, on average, from the time something like a national home builder buys a site to stick a shovel in the ground. Takes about 2 years. A lot of red tape, a lot of development, a lot of permitting variances. The government, right? And I think they would all say the same. It's always the government that slows things down.
And is that something that's increased, that impediment to construction over the last decade? We didn't, obviously, leading up to the financial crisis, we had plenty of growth and new construction. So did it get tighter subsequent to that?
I think so. And maybe, probably even in the, the last, really, the boom, there was maybe some overdevelopment, or maybe people weren't keeping a close enough eye on how they were developing. So it was kind of a free for all. So maybe some of it was good in how they, were able to take a better look at things. But I think overall, there's implemented too many processes and too much red tape to really slow it down, where now we cannot keep pace just because of that red tape.
Okay.
So here's an interesting question. I wanted to bring up 2024 and get your prediction, which of course, you know exactly what's going to happen. But
Yeah.
run it out a little bit and go 3 to 5 years. I'm just curious, what is your best guess as to how things are going to unfold between, say, more of the single family home construction as well as rental or multi-family?
Sure. Well, there's a lot to unwrap there, I think, Jim. It's honestly, financial markets. I think people always talk about how construction and housing kind of set the tone, and it's interesting being in that industry for such a long time, and how we do kind of set the tone. Everybody looks to housing for what's going to happen. So I think, will we ever see another boom like we did back in 06, 07, 08? Probably not. But I hope we also don't see the other end of that with the crash of, the 9s, 10s, and 11s that any of myself and friends in the business, we always say, if we can survive that, I think we can survive anything. So I hope we never see something like that again. So, I mean, really, going forward, 2024, I'll tell you what, I'm looking for, it's pretty ambitious, but about a 25% growth in business this year, simply because of everything, all the processes and pieces that we've perfected and put in place over the past 18 months. So that's almost an in-house goal for us. Where I see the market in general, again, I can really speak most eloquently to that mid-Atlantic region, and I see it continue to improve. I think if interest rates coming down, it's election year, so I think interest rates will probably come down Q1, Q2. We'll probably get people on the fence back into the market. Mm-hmm. So it's hard to say where new construction is going to go percentage-wise. Will we ever hit that million home mark again, Mike? That's a great question too. I think that's a good indicator. So in this area, I would say new construction will probably be up somewhere between 8 to 10%, based on what I'm hearing from some of my customers and our clients. Over the 3 to 5 year, again, a loaded question. I think it has to continue to increase. We are short on homes. Interest rates come down. I think that's a double-edged sword, because I think people will now maybe move again. People with a 3% mortgage that want to downsize, they're thinking, well, why would I downsize?
Right.
Because I'm going to get much less of a house at a higher interest rate. It's going to cost me the same money. Right. So those people aren't moving. And then, so you'll get people off the fence. If we see maybe even 5% again, 4%, somewhere down in there, I think those people start moving, freeing up some existing housing, and people start moving in. We're a transient country. So I think overall, if that all comes together, we'll see, real estate improve.
It's an interesting point you make on the, buying a smaller house, but with a higher mortgage rate. And so now you end up with the same amount of payment. So, yeah. Because what you had back in the 2000s, as interest rates came down, people bid housing prices up because they kind of view the cost of their house in the monthly payment, not whether they paid $300,000 or $400,000 or $500,000. It's what the monthly payment is. But I don't think we've seen in the last year, as interest rates went up, housing prices come down substantially to compensate for that. We just saw affordability go down. Sure. It became more difficult. So do you think that's something that'll get readjusted if rates stabilize or come down from here? Will housing prices stay similar, or will they start taking advantage of, rates are coming down and we can go back up in price again?
I think a lot of that is supply and demand. Again, in this area, Philadelphia market specifically, there's still bidding wars. I still hear it every day. $10, $20, $30, $40,000 over asking, even in that $500,000 price range, which seems absurd. But I think, again, when you get involved with multi-generation living, or even if, they're going to mom or dad for a $50,000 added down payment that they need in cash, because it's not even going to appraise for that. People are still getting that, and then somehow paying back mom and dad on the side. and taking a mortgage rate of, I think today is right around 7%, maybe 6.75%. So, I think it's all comes down to supply and demand, Mike. I'll be honest with you. I think as supply increases, I think it has to drive the price down even slightly.
Okay.
One of the things that maybe we can all speak to, and that has to do with where the new construction is taking place. And living outside of Philadelphia, it appears that there's, kind of the sprawl of the inner city coming out. People want to move out of the cities into the suburbs, and the major national home builders largely are only so happy to build those larger developments. It would seem like there would be a limited amount of space available to build the new homes, but somehow they keep finding the space. And as you say, one of the log jams is the amount of approval time that it takes for them to get there.
Sure. Yeah, absolutely. And even with the, I think you're seeing probably more and more townhome communities. I think the next generation doesn't want, the 2-acre lot with a 3,000 square foot home. They can still build a 2,500, 3,000 square foot townhome. But now, the next generation doesn't have the maintenance of the yard, the exterior maintenance. They're paying $500, $600, $700 an HOA fee, which will take care of all their exterior maintenance and probably grass cutting. And they still get a large home that they can go off on a cruise for 5 or 6 days. And I don't think they want to be as tied down as maybe the generation before them.
Right.
Is that the trend? I mean, trend wise, is that what you're seeing? Is a little smaller house, or is it?
Yeah, I think
more
a little
townhomes.
Yeah, a little bit smaller, and definitely a lot more townhomes. So, to your point, Mike, with that, I wonder if we'll see more of a demand in the smaller homes. That post-World War rancher, maybe even the bi-level and split level, as rates come down and maybe supply goes up. I wonder for that next generation. I wonder if that smaller home is going to become more of a demand. We could probably see a higher price there, and the big McMansions of the 1990s, maybe the demand there not so high.
Okay.
But that also plays into your hand. That's not the right way to put that. But the demand for your services, Trae, are still strong because you can apply or work for any number of different home builders, size of homes, as long as there's more of that. I guess you could say a basement. Is that fair?
Yeah. The basement level is huge. And you go west of the Mississippi. We don't have these tiny little windows that we do here on the East Coast. Everybody uses our products west of the Mississippi. It's kind of born around the Mormon cellar is where our products kind of deviated from or initiated from. And, with that is a lot more living space with natural light in the basement. Gone are the days of the dark cellar.
Interesting.
Yep.
Well, thank you. We've run out of time. We could certainly keep going because I find it very fascinating, as Mike, I'm sure you do as well. Hopefully you found it interesting as well and learned something. Our next guest is Ken Milner, an attorney with Warren McGraw and Knowles. They are a law firm specializing in personal injury located in Bluebell, PA. And in the meantime, thank you for listening, and tune in for the next show when that comes up.